Good morning, friends. Welcome to Adda 24/7. We are in selection MCQ series for BFM, and today's topic is market risk. Market risk means that risk which is not in your hands. Okay. See, there are basically three types of risks. Okay, why we'll do it when I cover the topic. Okay, let's start first. Firstly, welcome to the subject, and let's start. Okay. The liquidity risk for the bank arises from. So liquidity risk. Okay, where I was just covering this market risk part, right? So that this liquidity risk means basically what it comes as a part of that only. Remember, there are basically three types of risks main in Basel. One is credit, second is operations, and third is market. Okay, market risk arises not because of your fault. It is because of the fault of some other company, like Credit Suisse failing and all those things. Okay, and remaining two you can control it. Okay, so let's come to this liquidity risk part. Liquidity risk of the bank arises from. Liquidity risk means what? I don't have money to pay my EMIs. That's my liquidity risk. Bank doesn't have money to pay for their depositors. That's the liquidity risk. Okay, so that is known as liquidity risk. The liquidity risk of banks arises from. This was yesterday's homework. This was yesterday's homework. So this I had given you in last lecture. Yeah, the liquidity risk of the bank arises from funding of long-term assets by short-term liabilities, funding of short-term assets by long-term liabilities, funding of long-term liabilities by short-term assets, and none of these. So it was simple. Logic is very simple. See this. This is asset means loans. Okay, and this is deposit. Okay. So what does it mean? Suppose funding of long-term asset by short-term liabilities. 3 years loan of 1 lakh. Okay. Now this 1 lakh 3 years loan is funded by 1 year deposit. Means somebody has deposited 1 lakh with me as an FD, and I have given a loan for 3 years against that FD for same amount. So I'll definitely be in the problem. This is a problem, right? Why? Because this deposit guy will come to me after 1 year for withdrawal of money. So am I having that money after 3 years? No. After 1 year? No. Because I have given it for 3 years. So this person will pay me in 3 years, right? So that's why the problem over here is this will be my liquidity risk in case number A. What is case number B? Funding of short-term assets by long-term liabilities. Now again 1 lakh loan. Okay, short-term assets means 1 year loan by 3 year deposit. So will I be in the problem now? No problem. Why? Because this depositor who has deposited with me, okay, this guy will come after 3 years for withdrawal, and this guy is paying me immediately. So no problem in this. See. So funding of long-term liabilities by short-term assets. This is abruptly out. Okay, means ab initio this is out. How can I fund a liability using my assets? Right. I can fund an asset using my liability. I must have some money to give somebody, isn't it? Loan means giving that money. I must have money to give somebody. So how will I have money? Through deposits. So this C is absurd immediately. So what is the answer over here then? The correct answer is A, because this is the problem, right? So A is the answer. Liquidity risk arises from this. Okay, clear everyone? Simple one. Got it? See here, understanding is important, not just mugging up. Okay. The risk of adverse variance of mark-to-market value, change in market price of interest rate instruments, equities, is called as, means mark to market. Now focus on important words. Adverse variance of mark to market in market prices means adverse movement of my market prices. It's as simple as that. Adverse movement of my market prices. So that will result in what? Price risk, market risk, translation risk, both A and B. So what does it mean? Adverse variance of my market prices of instruments means, suppose if my bond price here, it all boils down to bonds. Okay, in bonds what happens if the interest rate goes up? Interest rate. Okay, then what happens? The price of the bond goes down. Price goes down. Okay, these are always inversely related. Now the problem over here is, if this interest rate goes up and price goes down. See this, what is given? Adverse variance of mark to market in the market prices of the interest rate instruments, market prices. So if my price of the bond goes down, okay, because interest rates are going up, so I had bought this bond for, let's say, 100, and now these bonds are always liquid. Now the price of this bond is, let's say, 80 rupees. So if I go to sell it in the market, I'll take a hit of 20 rupees. So that is what? That will result in number a price risk, isn't it? And market risk, yes, it will be. Why? Because it is, why did this bond price go down? Because of some external situation like Russia-Ukraine war or COVID. Because of these, the bond prices immediately get changed. Okay, so this is also market risk. So the answer will be what? A and B both. What is translation risk? Translation risk, okay, type fast in the comments section. Translation, what do you mean by translation? Forget this risk. What is translation? What is translation? When, if I give you some language, some book in Chinese, okay, and tell you to read, will you be able to read? No. Alright. Suppose if I translate that in English or Hindi or your local language, will you be able to read? Yes. So what am I doing? I am translating that foreign book into Indian language, whichever is acceptable to you. So that is translation. So same thing is happening over here also. Suppose if my bank SBI, let's say I am taking an example of SBI. Suppose SBI has New York branch. Let's say SBI New York, USA we'll call it. Call everything complete USA, okay? SBI might be having branches in USA, New York or some other states also of USA. So let's take it combined USA. So what is translation risk? On 31st March, what will SBI do? SBI will take the balance sheet of SBI USA complete, okay, all the cities, okay, all the states, and it will translate it to rupees. It is in dollars, that will be translated to rupees, and that is known as translation risk. So this risk has nothing to do with this market price and this whatever is going on with this adverse movement, okay. So the answer is both A and B. This is just the conversion of dollar, notional conversion. Translation risk is always notional. Remember this, notional. Notional means notional. What do you mean by notional? Notional means, suppose this on 31st March, okay, I am giving my balance sheet of SBI USA in rupees. So does it mean I am closing down my SBI USA branch? No. I am carrying on. It's just a notional profit or loss which I am seeing. Okay? Clear? What is not a forex risk? Not. See here, which of them is not a forex risk? A risk which may arise due to favorable exchange movements in the forex risk is called a forex risk. So favorable exchange rate. Favorable exchange rate means, suppose if I had bought dollar, let's say dollar, okay, at 80, okay, and now the dollar rate is, let's say, 90. So is it favorable or adverse to me? I had bought it. I have bought it first. Okay, this is called as long position. Long. When I buy first and sell later, okay, that is known as long position. So I am in a long position over here. In long position, favorable movement means I had bought it at 80 and now the price is 90. So it's favorable for me. So this is not a forex risk, isn't it? This is not a forex risk. Forex risk will arise when 80 I had bought and now it is 70 at the time of selling. So then it's a forex risk, right? So A is not a forex risk. What about B? Because all of these is also the answer. This occurs on account of open position in spot or forward market. Correct. What is open position? See, this is open position. I had bought the dollar at 80 and at the EOD, end of the day, I had kept it open. I didn't close that, I didn't sell that dollar, okay. So I had kept it open. So that is known as open position. So this also affects it. So this is also this is a part of forex risk. This is a forex risk. In fact, this is true, okay. We want false. This is false, okay. Now what is this? It is applicable to individual foreign currency. So this is also true. I had bought dollar, so dollar, it is applicable to dollar. If I bring pounds over here, then it will be applicable to pounds. So it is applicable to each individual currency. So this is also true. But what do I want? So is this the answer? All of these? No, I want not a forex risk. These two are forex risk. So answer is A. Okay, I want not. Okay. Before moving ahead, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study material plus live classes, ebooks, tests, everything. Whatever you need for clearing JIB and CIB, you will get it over here. Okay. So immediately download it. When an asset maturing in 2 years, liability risk will be basis risk, yield curve risk, gap risk, embedded option risk. What do you mean by this? Asset is maturing in 2 years. So this is a loan. Okay. Loan is for 2 years. So accordingly, as per the bucket system, what is bucket system of RBI? Bucket system says whenever I am having a loan of some period, of some amount, let's say 1 lakh. Okay. So if I am having a 1 lakh loan for 2 years, I must have equivalent deposit for the same amount and same period. So 2 years and 1 lakh. I must have a deposit also for that. Okay. So that is known as bucket system. So what does it mean? When an asset is maturing in 2 years, I need to have a deposit of 2 years. So this is what? What type of risk? Basis risk, yield curve risk, gap risk, or embedded option risk. So what can be the answer for this? What is the gap risk? See here, firstly let's understand few risks over here. Basis risk means what? There is a change in movement in the rate of interest of loans and deposits. Change in movement means if I am having a loan of 2 years at 1 lakh at let's say 9%. So it may happen that the deposit market is so fierce that I'll have to give a deposit at let's say 9 to 10% again, 9%. If it goes fierce, then where is my NIM, net interest margin? There's no NIM of mine, right? So here I'll face a problem. So the liability risk will be what? It will be a type of basis risk also. This can be the answer. Okay, I'll give you one more option over here, E, because there are 2-3 answers which I am seeing. Yield curve risk. Yield curve risk is different, altogether different. It has nothing to do with this this problem. Okay. Yield curve means basically what is the yield of the bonds which I might be having, various bonds, okay, which I might be having. So that is yield curve risks. Various maturities of the same grading of the bonds or same rating of the bonds. Okay, that is second one. Gap risk means what? Gap between the assets and liabilities. So that can also be faced. Embedded option risk. Embedded means what? The person who is having the loan may come back and withdraw the amount, give back the loan, or the depositor. The depositor who is having the deposit for 2 lakhs, that person can come back to me, and anytime the person can tell me that okay, I don't want your deposit, take this money back, this FD, and give me my money back. So this is also true. Okay, so the correct answer is A, C and D. Okay, A, C and D. This is the right answer over here, because when I am having an asset maturing in 2 years, the liability risk will be both basis risk, because if the rates change in different proportions, I will be facing the problem. Gap risk, the difference in between the loans and the deposits. Okay, and embedded option risk, all of them. So 3 of them, A, C and D. Funding liquidity risk is defined as, so liquidity risk means what basically? Liquidity means I don't have money to pay the EMI. So excess of liabilities over assets, excess of long-term liabilities over long-term assets, excess of short-term liabilities over short-term assets, inability to obtain funds to meet the cash flow obligations, and all of them. So which can be the answer? Liquidity risk, okay, means what? Excess of liabilities over assets means what? Suppose if I am having loans of let's say 100 rupees and deposits, okay, of 120 rupees. Okay, what does it mean? I am getting at 8% and I am paying at this again deposit. Let's say deposit is always lesser, okay, or we'll consider it same rate. Let's I am paying at 8%, so I am paying for 120 at 8%, and I am getting 100 rupees loan, means interest on 100 rupees at 8%. So this is excess of liabilities over assets. So if I am having more deposits than the loans, then I will be facing the problem. But generally what happens, if loan is 8%, deposit will be around 6%, so that it's adjusted. This 2% gap is known as our NIM, net interest margin, and this is what this 2% gap, this is actually what this actually means. It's a gap of 6 and 8. So if I am having equal amount of loans and deposits over here, I am giving lesser on the deposits and I am gaining more on the loans. So this generally, this is a trend followed. NIM is generally kept as 2 to 2.5%. So funding liquidity risk is defined as what? Excess of liabilities over assets, long-term liabilities or long-term assets, short-term liabilities, short-term assets. So all of them can be true over here. And inability to obtain funds to meet the cash flow obligations. Here, if I am having more liabilities than my assets, then definitely I will be facing the funding risk because money will go out more. So ABC are true, and that all of these ABC will result in D, inability to obtain funds to meet the cash flow obligation. So the answer is E. Okay. Liquidity risk in bank manifests in different dimensions. Which are these? Means manifest means comes. Okay, comes in different dimensions. Okay, so comes in different dimensions. So which are these? Funding risk arising from the need to replace net outflows, withdrawals, non-renewal of deposits. Means net outflows, whatever deposits are going on or going out, or non-renewal of deposits, whatever deposits are not renewed. So this can lead to my funding risk, right? So A can be the answer. Let's see. Up to you. It's up to you to answer. Time risk arises from the need to compensate for non-receipt of funds. So time risk means basically I don't receive the funds when it is required on time. Means NPA. If any loan becomes NPA, what happens? The main problem is I don't receive the principal and interest, EMI, right? So if I don't get the EMI, or if CC becomes NPA then interest, then in that case what happens? I don't have money to give it to the depositor. So that is also a point. B. Call risk arises due to crystallization of contingent liabilities. What is crystallization? Crystallization means coming of that security, paying cash. That is known as crystallization. Suppose if I am having, let's say, I am the bank, okay. This is my customer. Let's say he is a railway contractor, okay. Railway contractor. Now what happens for food? Let's say food. IRCTC, we have all those food now, and this is railways. So what will happen? IRCTC will tell this guy, you want a contract from us. So what you do? You bring a bank guarantee from the bank. So this customer will come to me. He or she will give me the FD. Okay. Based on this FD, I'll give a bank guarantee to this railways. Now what happens? If this guy doesn't perform well, or he doesn't satisfy the conditions of the railways, then railway will come to me as a bank, right? That this was your guarantee, now pay us because this guy has not performed. So once railway asks me to pay, I'll have to pay under this guarantee. So this is known as crystallization. So what can be the option for this? Liquidity risk in bank manifests in different dimensions. So which are these? Net outflows and non-renewal, time risk due to NPS, and call risk due to crystallization. All of these. D, isn't it? Subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CIB. Number 1. Number 2, you will be getting free YouTube series. Okay, all the free YouTube series you will be getting on all the various subjects. So subscribe to it immediately. Means what is this free YouTube series? Here the logic over here is, what are you watching right now? Right now you are watching the same, right? Free YouTube series on similarly on various subjects you will be getting it. Okay, so subscribe to it, click on the bell icon immediately. The features of basis risk are when the interest rates of different asset, liabilities and off balance sheet items change in different magnitudes. So that is basically the meaning of basis risk. What is basis risk? Deposit and loan change in different dimensions. Means loan and this is deposit. Okay, so if the rate of interest was earlier loan let's say 9% and deposit was let's say 7%, let's keep 2% NIM. Now if the loan goes from 9% to 10% and deposit goes from 7 to 9, so earlier I was earning how much? 9 minus 2 7, 9 minus 7 2%. Now I am earning how much? 10 minus 9 1%. So my income has reduced. So when the changes in rate of interest for various loans and deposit products changes in different magnitudes, that is called as the basis risk. So this can be true. When the interest rate of assets rise in different magnitudes as compared to the interest in the corresponding liabilities, which may result in variation in net interest income, it would be known as basis risk. So interest rate in assets rise in different magnitudes as compared to interest in liabilities. So that's what we are discussing over here. So B is also the same, only wordings are changed. The basis risk is quite visible in volatile interest rate scenario. Volatile, huge changing interest rate. Okay, so that happens generally when there is extreme inflation. In that case, it's a huge volatile scenario. So the answer is what? A, B, C or D, all of these. The answer is correct, D. Got it, everyone? So now, by now all of you might have done the registration. Okay, for those who have not, kindly do it fast. Okay, you'll be applying some charges for that now. So remember, do it fast, because otherwise you'll learn everything, study everything, and you won't register. Then it's of no use. And select the elective properly where you are comfortable with. Okay. Okay, now what is batch? Selection batch. Look at this. This batch we are covering all the 4 subjects: ABM, BFM, ABFM, BRBL, compulsory ones, numericals, objective questions, case studies, everything is covered. 80% off discount is going on, double validity on Mahapack. What is Mahapack? 15 plus batches per subject. Okay, so that is Mahapack. Go for, in fact, I would suggest you should go for the Mahapack because you have 2 months left, right? So use the code Y432, this one. Okay, how to use it? Let me show you. So this, go to Adda 24/7. If you are having the app, go through the app. In the app, you are getting 1% extra using the coin systems. Okay, so go to Adda 24/7. Click on the front page itself. Click on JIB and CIB. Click on CIB 23 now. Click CIB 23. You'll see the details. See this details. Okay. Click on the English batch. Once clicked, you'll see the details of the batch. What are the days, timings, what are the study plans, everything. Okay. Recorded videos are available, remember, importantly. So if you miss out on any class, you can definitely get back to the class using recorded sessions. Also, 2-way interactive classes. You can ask the questions there and then itself. Click on more offers. Put the code Y432. Y432. Click on apply. Okay. See this. 80% off. 47,999 means 23,999 reduces to 4799. Such a huge discount you are getting. In fact, in Mahapacks, you are getting 15 plus batches. Okay. You should go for these batches as well as Mahapacks. Okay. See the JIB, CIB, Mahapack. Click on CIB ka Mahapack. See the CIB ka Mahapack. You will get the details. You read the details. Importantly, I'll tell you, validity is increased for 6 plus 6 months. That is only for the offer. Okay. 15 plus batches per subject. You will see the details. Even electives are covered over here. Okay. Remember this. In Mahapack, electives are covered. Okay. So that's why I would suggest, because you should go for the Mahapacks because mainly electives. Okay. Okay. So look at the fees, 76.99. Let's click on more offers. Put the code Y432. Click on apply. Look at this, 34,999 reduces to 6,999.80. Such a huge discount. Okay, validity double, 6 plus 6 months. So such offers don't come every now and then. Okay, join the batches, join the Mahapacks, because only 2 months are remaining, and importantly, this is an investment for lifetime, isn't it? So I would always suggest everyone should join the batches because professional guidance will be required to you. Be clear about it. Okay. Chalo, bye.